All right, so welcome back, guys. I'm back with Cruz from the great state of Washington. When I think about Washington, the only state that comes to mind, no, the only thing I know about Washington is Amazon. Washington is the home of Jeff Bezos and and
Yeah.
Amazon. That is the only thing I know about Washington. And I also know it's it borders Canada. That is it. I've never been.
Yeah.
I don't even know what it looks like. So yeah,
Oh,
but
it's a lot of green spaces, a lot of mountains, man. You'll
I
love it out here.
okay, yeah, it's always good to try something new. So, but yeah, I'm back here with Cruz. So this guy, he's excited, he's motivated, and he can't wait to pass his not to pass his exam. So that is what I'm trying to do. I'm trying to help him to pass his exam. And I believe 100% with the level of effort he's putting in, it's just a matter of time he will pass his exam. So we're just going to resume where we left off. So this time around, we're talking about beneficiary destinations, right? So now,
Yes.
as I was saying, the main purpose of life insurance, and when we get to annuities, we'll contrast annuities and life insurance, right? But the main purpose of life insurance is to provide death benefit. That is it. Now, life insurance has a lot of other benefits, like you have tax benefits, you have living benefits where you can take up loans and you can make withdrawals and all of that stuff, and then you have accelerated death benefits. So it has a lot of benefits, but the main purpose of life insurance and, and on the exam, they may ask you to contrast life insurance and annuities, right? So the main objective of life insurance is to provide a death benefit. So, and maybe this is another reason why some people don't like life insurance, because there's a little bit of selfishness. Why should I pay for something that I will not enjoy, that someone else will enjoy when I die?
Yeah. Yeah.
you know, and and that's a problem that we face. I mean, I'm African. That's a common problem in the African community. Like people have this weird notion about life insurance. Like, no, well, if I'm not going to use it, I'm not going to bother about it. Now, whereas annuities, on the other hand, the main purpose of annuity is to provide you a lifetime income, right? So think about all your folks who are thinking about retirement and all of that stuff. Annuity provides you income for the rest of your life, guaranteed income for the rest of your life. Now, annuity has death benefit, but that is not the main purpose of annuity. So both of them have a little bit of each other. Life insurance has living benefits like policy loans and accelerated death benefits where you have access to cash and all of those things. But that is not the main reason for life insurance. Life insurance could possibly give you income for life, but that is not the main purpose. The main purpose is to provide a death benefit. Annuities, on the other hand, the main purpose of annuity is to provide you income that you cannot outlive. So you may see the word outlive on the exam. It all means the same. To provide you income for life, to provide you income that you cannot outlive, it all means the same. But annuity provides you income for the rest of your life. Now, you have death benefits, all of that with annuities, but that is not the main purpose. So now we just got that out of the way. Now, so if you don't select a beneficiary, it kind of defeats the purpose of life insurance, because the purpose of life insurance is to provide death benefits. So if there's no one to receive the money when you die, then what's the point of having life
Yeah.
insurance?
You're just paying for nothing.
Exactly. So now you have beneficiary destinations options. So what does that mean? And guys, for you guys just tuning in, if you didn't listen to part one of this, again, Cruz, this is for the Washington State life insurance exam. But again, this is the general portion. So this will apply to all 50 states. All right. So beneficiary destinations. You have you have three beneficiary destinations. The first one here, I don't know if you can see my paper. I'm going to write this down here. So the first
Yeah.
one here is individual. So what does that mean? So that means you can name a particular individual. You say, okay, you know what? I'm applying for life insurance. I want my wife not your wife, but you spell her name, out. I want, Mary Jean to be my beneficiary, right? So when you specify who you want your beneficiary to be, that's called individual beneficiary destination, right? So that's the first. Now, the other beneficiary destination option is to do class. So a very good example of this is someone could say, okay, you know what? I can't predict the future. I may have kids outside of my marriage, whatever. So I'm not going to name any one kid because I probably don't know who my kids are. But you know what? I'm going to make the beneficiary destination to be all my kids. So it doesn't matter as all my, you can even specify to be all my biologic children. So as long as they can prove that your biologic child, even though you didn't name them in the insurance contract, they have entitled to money. Exactly, they are entitled to money. Now, 99.9% of life insurance beneficiary destination will be individual, where you specify a specific individual. Now, just for this, people can also make life insurance beneficiary to be like an entity. So like I did a policy for a business owner, and she put, she gave 50% of her death benefit to a charity, right? So you can leave money behind for charity. So the charity can be your beneficiary destination option. You can leave it behind for you can name a corporation, you can name a school, an institution, a church, anything. But most of the time, again, 99.9% of the time, beneficiary destinations are individuals. Okay, so you have class. Now, the last option here is minors. What you need to know about minors is very important. We all know minors are people under the age of 18. Okay, so for life insurance purposes, and this may be on your exam, life insurance death benefits can never, ever, ever be paid to minors. Okay, never, nada. Okay, so until that kid turns 18, by law, the insurance company cannot pay the death benefit to that person. This is where you as an agent, let me step away from the exam prep here, just giving some few training. You as the agent for parents who, especially single parents who are putting down minors as the beneficiary. Let's say, you see people do this all the time. They'll make their 2-year-old kid 100% beneficiary. Well, someone is going to take care of that kid, right? So you need to leave at least, even if it's 10% or 5%, give at least 5 or 10 or even 20% to that person who will take care of your kids. So now, if something were to happen to you, at least there's money there to take care of your kid until your kid turns 18. Because the sad thing is, and I've seen this quite a bit, where children, their parents have life insurance that left them as 100% beneficiaries, but they're under the age of, they're underage, they're 10, 11 years old, and that kid has to suffer until they turn 18. Yes, they have money there. They got $1 million.
But they cannot get it out.
Exactly, but they can't get it out, and they're suffering until they turn 18. So you don't want to do that. And another way to get around that is to actually set up a trust. So now you can make the trust the beneficiary of the life insurance, and then make your kids the beneficiary of the trust. In that way, your kids can get money before the age of 18. But just for exam purposes, know that life insurance death benefits can never, ever, ever be paid to minors. Okay, so we'll cover individuals, we'll cover class, and we'll cover minors. So I'll stop here quickly and just see if you have any questions.
No, actually, no. Let's see. Let me review what you said in a brief second. Okay.
Okay.
So, life insurance main benefit is to provide money after death for death benefits.
Yeah.
Annuities main purpose is to provide income during life that you cannot outlive.
Perfect.
And it does have some death benefits, but it's not the main purpose, as well as life insurance does have some life benefits, but it's not the main purpose.
Perfect.
Beneficiary destinations, three of them. We just went over them. The first one is individuals, which is the main one. The 99% of the people use individuals as a beneficiary.
Mm-hmm.
And then class, which is, for example, if you have kids, known or unknown kids,
Mm-hmm.
that you want to name as beneficiaries, as long as they can prove they're your children, they'll get it.
Mm-hmm.
And minors, this can be any minors. It doesn't necessarily have to be your children. It just has to be any minors. However, if you do choose minors, you said as an agent, we are to be telling them that they will not be receiving any money until the age of 18.
Yes.
So it's better for you to pick a beneficiary that will help distribute some money to them, or set up a trust. That way they can receive the money beforehand.
Yep.
Right?
Yep. That's it. Yeah. Someone's gonna ace their exam.
Yeah.
I see that. You're gonna ace that test, brother.
Yeah. Yeah. Amen. Yes, I will.
All right. So now we can cross off beneficiary destination options. Now let's talk about let's talk about the types of beneficiary, right? Now you have the beneficiary can either be primary or contingent. What does that mean? So the primary beneficiary is the first person who is entitled.
Yes.
Yeah.
Hold on. Let me try before let me try that.
Okay. Okay. Sure.
I think I know this one. Correct me if I'm wrong. Sorry. I like to kind of guess.
Oh no, it's okay.
So the primary beneficiary would be this. You have life insurance, correct?
Yeah.
And as a policy owner, which I would be the policy owner, I can choose a beneficiary, right?
Yes.
Now, the beneficiary can be the number one beneficiary would be my wife. I choose her to be the beneficiary.
Okay.
But there's potentially an option that I can choose a contingent beneficiary in case she passes away and I pass away, then my children can be a contingent beneficiary, correct?
Perfect. Perfect.
Okay.
Yeah. So either the primary beneficiary passes away, or if they cannot locate the primary beneficiary, now, and then every insurance, they'll have different policies, but if they cannot locate the primary beneficiary for a certain length of time, then that money goes towards to the contingent beneficiary. So the contingent beneficiary only comes in place when the primary beneficiary is either dead or the insurance company cannot locate them. This is why, again, this is not going to be on your exam, but a little field training, because in the next few weeks, you're going to be a licensed financial professional. And for those of you listening, hopefully in the next few weeks, all of you will be licensed financial professionals. So you just have to know this. So this is why when you, especially for primary beneficiaries, when you're doing the application, make sure you get as much information on that individual as possible, because I'll see clients do this all the time. Oh, what's the person's phone number? Oh, I don't remember their phone number. Okay, what's their email? Oh, I'm not too sure. Okay, is there a way you could get it? Well, yeah, I don't have it now, but it's not urgent. And I tell them, what if God forbid you have to die? There's no phone number, there's no email. Like literally, I did this for a 30-year-old client of mine. This was on Thursday, and she put her cousin down as one of her primary beneficiaries, but she had not talked to him in months. She said, oh yeah, I know he moved, but I don't know where he lives. Okay, what about his email? Oh, I don't have his email. What is his phone number? Oh, he just changed phone numbers recently. Okay, are you sure you still want to put him down? You want because now, what if God forbid you die? There's no phone number, there's no email address, so how would they locate? And that brings me to the next point. You have a lot of people who die, and the life insurance company cannot locate their beneficiaries, right? So when that happens, the money, when that happens, the money ends up sitting there going to no one, right? So you always want to make sure you get as much information as possible for the primary beneficiary. All right. So let's
Now,
come. Go
um,
ahead.
if
Mhm.
if do they have a certain period of time to try to find them?
Yes, it varies by insurance company. So if they don't, if they can't find them, then that money goes towards the insurance estate. No,
Okay.
so it'll go towards no, it'll go towards the insurance estate. And again, as I said, for exam purposes, most of the time they'll use insured and policy owner interchangeably. So they can use policy owner to refer to both, policy owner and insured. But if they cannot locate the beneficiary, then the money gets to go to the insurance estate.
Okay.
Yeah. All right. Now the next thing, so we know primary versus contingent beneficiary. Okay. Now, while we're on this, you see, we're making progress. We're checking all of this off. So while we're on this, we come here to something else. It's called um, the common disaster clause. This 100% will be on your exam. Okay, 100%.
Yeah, I saw
So the
that.
common and do you know what the common disaster clause is?
So the common disaster clause, I was one of the ones that I failed. I remember that
Okay.
when I first took the exam. But I learned that the common disaster clause is this. So say I'm the policyholder and I'm the main the insurer, right? The insured.
Mhm,
I name my wife as beneficiary, but if we both pass away in the same vehicle, right?
mhm,
Um, say either I pass away right away and she dies about maybe 10 days later,
mhm,
then that is a common disaster clause right there. So the
mhm.
beneficiary will then go to the contingent fund if there is any. Or if not, it will go to the estate. Am I right?
Perfect, perfect,
Okay, yes. I
perfect,
learned.
perfect. But why is that the case? No, how is the or why can the contingent beneficiary get the money when both the primary beneficiary and and the the insured die in the same accident?
um, I believe it's because first of all, they were named contingent beneficiaries by the policyholder, first of all.
Mhm,
But second of all, is because they were both in the same accident, the
mhm.
clause says that it has to go to the next person in line
Mhm.
to the beneficiary. Um, if that makes sense. I don't know if that answers the question or not.
Oh no, that's it. So the reason it can go to the contingent beneficiary is because if both the insured and the primary beneficiary die in an accident, the insurance company is always automatically going to assume that the insured, that the insured on the exam, they may use the word pre-deceased, that insured pre-deceased or died before. Pre-deceased, died before, all means the same. No, so pre-deceased is just a big term for died before, right? So they're going to assume that the insured pre-deceased, no, I'm sorry, they're going to make sure that they're going to assume that the primary beneficiary predeceased the insured, right? So if the primary beneficiary died before the insured, then now the money can go to the contingent beneficiary. Now, what we got to know is that, because think about it, if the insured dies and the primary beneficiary is not available, then it goes to the contingent beneficiary, right? So they're going to assume that the primary beneficiary died first, right? And the insured died after. So now, since the insured died after, that money goes towards to the contingent beneficiary. But if it's assumed that the primary beneficiary died first,
Mhm.
right? Right? I'm sorry. If it's assumed that the insured died first, then that money should go to the primary beneficiary. But the primary beneficiary is already dead, right? So that money has to go to someone, right? So
Oh,
they'll
okay.
assume that the primary beneficiary died before, or quote unquote pre-deceased the
Right.
insured, and that money goes to the contingent
So,
beneficiary.
so if I'm understanding correctly, the way that I said is if the insured and the beneficiary, the primary beneficiary, both die in
Mhm.
an accident,
Yes.
they both pass away. It doesn't matter who died first or what, right? And
Mhm.
their insurance company is always going to assume the primary beneficiary predeceased the
Perfect.
insured, and then they'll go. It doesn't matter if the insured uh, medically, it does not matter if the insured dies first and then the
Well,
beneficiary.
it does up to a point, usually within the first 90 days. So as long as both of
90
them
days.
die
I saw
within
that.
90 days of each other, yes.
Yes, I saw that on the exam. One of the
Yeah.
practice questions is that yeah, you're right. If they have a certain time limit, if it passes that time limit, then but yeah, if they both die, actually it was 10 days on PSI, I think it says that it has to die within 10 days. The beneficiary has to die within 10 days of the insurer died,
Mhm.
so that way they can go to the contingent beneficiary. But
Okay.
yeah, that makes sense. Okay, that makes sense what you're saying.
Okay, perfect. And that's called the common disaster clause. So they may phrase the question in such a way, they may say, which life insurance provision assumes no, okay, if both the insured and the primary beneficiary die in an accident, which life insurance provision assumes that the primary beneficiary predeceased the insured? A, common disaster clause. B, ownership. C, entire contract. D, D could be reinstatement, right? So you should know that the answer will be A, common disaster clause, right? So they could phrase it either way. All right. So we got that
Yeah.
out. Okay. So now let's talk about you have two different um let's see here. I thought it would be here. It's not on your exam, but I'll still go ahead and cover it. It's not on your exam outline, but I'll still go ahead and talk about it. Okay. So you have two different classes of beneficiaries, right? So two different classes of beneficiaries. You have revocable and
And
irrevocable.
irrevocable.
Can you tell me what you know about the two? Like, what's the difference between the two?
Okay, so when it comes to a revocable beneficiary,
Mhm.
again, the policy owner is the only one that can control the policy.
Okay.
Nobody else, not the beneficiary. So when the policy owner chooses a revocable beneficiary, that means at the will of the policyholder,
Mhm.
he can change the beneficiary whenever he wants. So
Perfect.
he can change it from the wife to the auntie to the grandma to back to the wife
Perfect.
whenever he feels like it.
Perfect.
But if it's irrevocable, then the only way to change it would have to get the approval of the beneficiary.
Perfect. Perfect. No, not just approval, but the written approval.
Written approval, yes, it has to be signed by both the
Mhm.
policy owner and the primary beneficiary.
Look at that, man.
Yes.
Someone's gonna ace this exam. All right, that's
Wow.
great. That's great. That's great. Okay. So now we finish all of this. Now, the next thing, let's talk about settlement options. Settlement options. So when you think about settlement, what should you think about? When you think about settlement, think about
I think of lawsuits.
perfect, perfect,
So,
perfect,
like a
perfect.
settlement would be,
Mhm,
let's say, uh, person A sues person B,
mhm,
and they're suing them for $50,000. So,
mhm,
what a settlement option would do is, if person B dies and they have a certain life insurance, then they'll
mhm.
that life insurance will pay person A's lawsuit. Is that kind of
Yeah,
what it
yeah,
is?
that's settlement. No, no, settlement. When you think about settlement, just think about money you receive from a lawsuit, right? From
Oh,
a
okay.
lawsuit or from a legal case. So you
Oh,
have divorce settlement, right? Like
right.
one of my clients, she was, because a lot of women dream about marrying rich, rich guys. She was one of those. She was one of those women that actually realized that dream. So she married not a millionaire, but pretty close to it. So, got long story short, the divorce and her divorce settlement, I think, was $600,000. 600,000, right? So now that was a settlement because you get, usually due to a legal proceeding, you get cash, you get money. Or think about if you're involved in an accident, and now the insurance company settles with you, right? Insurance settlement, right? Divorce settlement, legal settlement. So it just has to do with another company paying you money, right? Or another
Right.
entity paying you money because of a dispute. Now, for life insurance, we have settlement options. So the settlement options are just ways that you as a policy, I'm sorry, the ways that the beneficiary can be able to take out that money that they're entitled to, right? Because now, what is the default settlement options for life insurance? This may be on your exam. What is the default settlement options for life insurance?
I don't remember.
Cash, cash. You know, is lump sum cash payment. You know, think about the lottery, right? When people win the lottery, what is the most common settlement option for the lottery? Lump sum.
Yeah, lump sum, yeah, or payment installments.
Yes, yes. So yes, so the lump sum, everybody wants, like, you know what? Give me all my cash now. Like, give it. If I win 600 million, give me 600 million now. No, I don't want to wait 10 years to get it. I want it now, right? So life insurance, the most common settlement option is cash lump sum, right? And that is the default settlement option. Meaning, if you, the policy owner, do not select any settlement option, then the life insurance company would automatically default to settlement option. Now, keep in mind that the beneficiary also has the option or has the right to select a settlement option, but the primary responsibility for that goes to the policy owner. And if the policy owner does not select a settlement option, then that's when the beneficiary, may have the option to select a settlement option. But the beneficiary cannot override the policy owner's settlement option. So, for example, if you on your life insurance, in your life insurance policy, you say, okay, I want a settlement option. And people will do this usually for kids, right? Say, okay, I want a life insurance option to be lifetime income for my kid. So let's say it's a $1 million policy, but don't give them all that $1 million upfront, because most 18 or even 20 or 21-year-old, they get $1 million that they didn't work for. Most of them would just blow it, right? So I said, okay, you know what? Give them lifetime income. Even if it's 20,000 or 50,000 every year for the rest of their life, right? So now you have the life income settlement option. Now, the beneficiary cannot come back after you're dead and say, oh, no. God forbid you die. Your kids cannot, if you select life income, your kids cannot come to the insurance and say, nah, yeah, my daddy said lifetime income, but give me all my cash now. No. Right?
It has to be chosen beforehand.
Exactly. So if the policy owner doesn't choose it, then the beneficiary has the right to choose it. But if you, the policy owner, choose it, the beneficiary cannot override that. And this is usually good for parents who want to ensure that their kids don't blow up the money. So they'll choose a settlement option other than the cash payment option. And this is something I usually recommend to parents, especially if they have very young kids, because most of the time kids get a huge lump sum of money. They don't work for it. Most of the 9 or 10 times they'll blow it, right? And
yeah, before they're 21, they'll be gone.
Exactly. So now these are the settlement options. So the settlement options are just different ways that the beneficiary can receive the money. Okay. So yeah, for your state exam, let's look here on your exam outline. First, my document camera. So the first settlement option is cash lump sum. And as I said, this is the default. So if you, the policy owner, you don't select a settlement option, this is what the insurance company automatically default to. So the default settlement option, okay? So it's cash lump sum. Now, the other thing too you got to know for exam purposes is the cash lump sum is never taxed for life insurance. So life insurance lump sum death benefit is never ever taxed.
That's the settlement option is not taxed.
No, cash lump sum cash benefit.
The lump sum cash payment is not taxed. Okay.
Yeah, exactly. Right. But now, if you do interest only is taxed, because interest only benefit settlement option is considered like how do you call it? It's considered it's considered profit, right? So if you get all the money up front, it's not taxed. But if you get interest payments, then because that's earned interest income. So what the interest on the income would be something like this, right? You leave 500,000. Let's just say you leave 500,000 for your wife, right? And God forbid you die, your wife has 500,000. So maybe you like you say, you know what? I want to give my life enough, only pay my wife the interest, right, on this money, and then when she dies, pay my kids, the lump sum, right? So now
Okay.
your wife will only be receiving the earned interest. So let's say you have 500,000 lump sum, the death benefit, and let's say you're getting 10% interest every year. So every year, your wife is getting $50,000, right? So now your wife will be getting $50,000, only until she passes away, or maybe for a certain time, right?
Okay.
And then when she passes away, then that 500,000 death benefit goes to your kids. Now, because that 50,000 is considered interest income, remember, anytime you earn interest on something, obviously once it's
Tax
stopped,
on that.
it's going to be taxed.
Yeah. Okay.
I mean, when you really understand how, especially life insurance works, and how the rich people use it to their benefits, like all these little things, man. I mean, this is how you create generational wealth,
Yeah.
yeah,
And seeing that.
yeah. So that's interest only. So they're only paying you the interest, not the actual death benefit, right? They're only paying the interest income on that. Now, the next settlement option is life income. So this 1 year, they're paying you income for life. So let's say the 500,000, they say, okay, you know what? We're going to pay your wife $500,000 for life, right? So that is the life income option, right? So once your wife, God forbid, she dies, then that money stops. So if your wife were to, let's say, only get that money for, let's say she getting 50,000 every year, and she only gets it for 2 years, that's 100,000, right? The remaining 400,000 will stay with the insurance company. This is why, for exam purposes, you also have to know the life settlement income option will be, it will usually provide among the different life settlement options. Okay, let me not confuse you. I'll go in a little more detail. Let me write it here. So under life settlement,
This is the life income option, right?
yeah, under the life income option, or that's the life settlement option. Okay, you have a couple of different options. This will be mostly on the annuities part, but we're also going to detail right now. So here, under that, you have the there are different names. So it's called straight life. Another name is pure life. Another name is life with no refund. Okay, so these all mean the same. So these are the first type of life settlement option. Remember, life settlement is something that provides you income for life, right? So that's life. Then you have another one we say life with period certain. Again, you see this on the annuities part, but I'll just go over it now. You see life with period certain. So what does this mean is that, okay,
Certain amount of time.
yeah, the insurance, okay, you know what? Give me income for the rest of my life, but if I die within that period of time, let's say I say, okay, give me a 10-year, I want my settlement option to be 10-year, life with 10-year period certain. So that means that if I die within those 10 years, that money goes to my contingent beneficiary, right? Or to whoever that I choose for that money to go to. But now let me not confuse you. We'll wait until we get to the annuities part, because this, you find this mostly with annuities. So we'll just take to the life. We'll just take.
So the
to
life settlement option is straight life, pure life, and life with no refund. Those are the three options that you get with the life life settlement option.
No. So yes, that's one type of life, but all of those mean the same. So straight life, another name for it is pure life.
That's
Life
what those are different
exactly
ways to say that.
different names. So straight
Oh, okay,
life,
I understand.
pure life, life with no refund. It just means that they're going to give you income for the rest of your life, but when you die, there's no more income payments in. So it's also called straight life. It's also called pure life. It's also called life with no refund. So those
Okay.
are all three. Because on the exam, you
Those
got to
can be
know the
used
synonyms.
interchangeably, and
Exactly.
and they'll show up on the exam one way or another in those forms, but it
Exactly.
all means life settlement option.
Exactly.
Okay.
Okay. So now the third settlement or fourth settlement option is fixed period. What does this mean? So the insurance company will say, okay, to your wife, they say, okay, Miss Cruz, we're you know what, you have $500,000 death benefit, but you know what, we're going to give you $50,000 for 10 years. Now, once that 50,000 is up, once the 10 years is up, that's it. No more benefit. So they can guarantee a certain amount for they can guarantee payments for a fixed length of time, right? So that's fixed period. The fifth option here is they can do fixed amount installments. So this one they're saying, okay, you have 500,000 Miss Cruz. We're going to pay you 50,000 every year until that 500,000 runs out. Now, remember, if your money stays with the life insurance company in most states for more than 30 days, they are required by law to pay you interest, okay? So if the life insurance company doesn't pay your death benefit within 30 days, by law, they're supposed to pay you interest because the money is sitting there. I mean, the money is not just sitting there where they're just watching it. They're reinvesting that money and making money on it, right? The same way with banks. A lot of people think when you put your money in the bank will just take a bowl and just wrap a bowl around it. No, the bank takes that money, and the bank will reinvest it, right? So it's the same with the life insurance company. So the state law says if you don't pay the death benefit more than 30 days, again, this is most states, you have to start paying the beneficiary interest. So in this case, your fixed amount installments will include interest and principal, right? So let's say even though it's 500,000, but let's say she's getting 10%, let's just say 5% a year, right? So she's getting about $25,000 interest income. So her payment, let's say the insurance company could say, okay, we can pay you maybe 50,000 every single year. But instead of that money running out in 10 years, maybe it'll run out in 15 years because it's interest payment added to it, right?
But when the company doesn't pay you within those 30 days, are you still paying taxes on the interest that they give you?
Oh, no. You don't pay tax until you receive it.
No. What I mean is, how you just said right now, if you choose this option and the company for some reason doesn't pay you within 30 days, right?
Oh, yes.
So they're supposed to pay you that amount plus interest.
Yes.
The interest that you get after, you're paying taxes on the interest, correct?
Perfect. So you asked a very good question. Life insurance policies are considered they're considered let me not give the wrong information. Let me just check this out quickly, because you have two things here. You have let me show you here. It's something called FIFO, right? First in.
Yes, that's the one I was asking you about a couple of days ago. Remember on Wednesday?
Yes.
First in, first out.
Yeah, first in, first out, right?
Yes.
So life insurance policies are considered FIFO policies, FIFO, right? So first in, first out. So let me draw this here for you to see it, because we understand it. So let's just say Cruz puts in a total of 500,000. Your death benefit is 500,000. And now your wife chooses to do fixed amount installments. And over the course of, let's say, 10 years, that 500,000 plus interest and everything is actually ends up being 700,000. So 700,000 minus 200 is what? Minus 500 is 200,000, right? So 200K. So 200K represents the profit or interest, right? So for tax purposes, the first 500 she received will be assumed that that is what was in the policy. No, that was what was first in. That is the death benefit she was entitled to. Remember, the death benefit is not taxed, right? So that first 500,000 up until that death benefit limit is not taxed. So she can be receiving 50,000 every single year for the first 10 years, not taxed. After she exhausts that 50,000 and that death benefit, then any payment after that now will be considered return of interest. So the last 200,000 she receives will be taxed. So life insurance operates on a FIFO basis, first in, first out for tax purposes. FIFO, F-I-F-O. Okay, so now we have, so that's fixed installment. Now, the other thing we have here, the life settlement option, is we have joint settlement options, right? So again, you see this mostly in annuities. Again, we'll get to it, right? But in annuities, or let's just use this for example. You can have joint settlement options. So you can have two people, right? Two beneficiaries receiving income for life. But once one of them dies, the income stops. So let's say you and your wife, for example, let's say your dad left you and your wife money, right? Or let's just say, let's say your dad left you and your sister $1 million, right? And your dad selects a joint settlement option. That means pay all my two kids, yearly or monthly income for the rest of their life. Now, with joint income, the key is two people are receiving benefit payments, but the benefit payment ceases upon the death of the first person. So when the first person dies, the benefit payment ceases. Okay, but you find this mostly in annuities where the death benefit payment will cease when the first annuitant dies.
Okay.
But you can find in life insurance too, where the death benefit will cease when the first beneficiary died. Okay, now for last survivor, another name for last survivor, and let me put this here. So another name for last survivor is called last to die. Because on the exam, they may not just use one term, they may use more than one. So you got to know what all of them mean is synonym. So last to die. Another name is joint and survivor. So that means it's joint. You have two people receiving benefits, but the benefit payments continue until the last person dies. So
it's a better option, isn't it?
Yeah. Yeah. But the benefit payments for joint and survivor will always be less than the benefit payment for joint.
Oh, really?
Okay. Yeah. So now let me stop here. I know we cover cash payments, interest, 1, 2, 3, 4, 5, 6, 7. So 7 benefit, settlement options: cash payment, interest only, life income, fixed period, fixed amount installments, joint, and last survivor. So let me just test you here and make sure you understand. So in your own words, list the 7 benefit options and explain them.
So lump sum, that's when you get a big amount of cash all at once. Instead of getting them payments, you get it all at once.
Okay.
That one is taxed. You get taxed on the lump sum. No, excuse me. Wait. Lump sum is not taxed. Sorry.
Perfect.
Not taxed.
Lump sum is never taxed.
Now, the other option will be the interest only. And that one is taxed. That's when you get, you do get the interest part first, and then when the person that receiving the interest dies, the beneficiary will get the full amount of the life insurance.
Okay.
The life income option, that one is where If I understood it right, you get payments over the course of a certain amount of time or until you die. Correct? Did I get that right?
No, the life income you get income for the rest of your life, but income stop when you die.
Right, right. That's okay. So yeah, you do get income for the rest of your, you get a certain amount for the rest of your life, and then it stops once you die.
Okay. And life now you have different types of life settlement options, but we'll get to that mostly when we get to annuities. But you have so pure life. So
Yeah,
what are
because you have three of them, right? You
yeah,
have straight life, pure life, and life with no refund.
no, but straight life, pure life, and life with no refund is all the same. They all mean the same thing. So that means
Okay.
payment cease when payment cease when payments will cease when when
Oh,
the beneficiary dies. Now you have other life settlement options. For example,
yeah.
you have life with refund. You have other ones, but I don't want to confuse you when we get to the annuities portion.
Because that's in the annuities, right?
Yes, that's the annuities. So when we
Okay.
get to annuities, we're going to talk about
So the next one after life income
that.
is a fixed period.
Okay.
Now, fixed period is, say you choose 10 years, right?
Mm-hmm.
So you'll get the income for 10 years, but if you die with before those 10 years are up, the income ceases to come.
Uh,
Right?
no, so fixed period will guarantee you income for a certain period of time. So and usually, if you die within that time, they'll pay the money to your estate, or they'll pay the money to whoever whoever you designate.
Oh, okay,
Yeah.
okay, okay. Let me write that down before I forget.
Okay.
I wrote it down wrong.
Okay.
So that is fixed period, fixed period.
Mm-hmm. Okay.
Okay. So fixed period is when you get payments for a certain period of time.
Mm-hmm.
Say you choose as a recipient of that income, you choose 10 years, for example.
Yeah.
Then you'll get money for those 10 years.
Okay.
But if you die within those 10 years,
Mm-hmm.
your beneficiaries will get the lump sum of whatever is left over, or the whole benefit.
No, your beneficiaries will get the remaining amount. They'll get the money from
Whatever is left over of the payments that,
yeah,
so
yeah, they'll
say,
get the remaining. So let's say you have a 10-year fixed period, right? And you die, and let's say you're receiving, yeah, you get a 10-year fixed period, you're receiving benefit payments, and maybe after 2 years you die. So now whoever you designate, or your estate. So they'll look first if you designate someone to get that money, or if you don't have, then they'll pay to your estate. But now they'll pay for the difference. So you're supposed to get it for
right,
10
the
years, you only
difference.
got it for 2. So now you'll continue to pay for 8 years.
Okay. So, okay, there we go. Difference. The difference is paid
Mhm.
to the beneficiaries. Right. Okay. All right. That's my stomach growling.
Yeah.
Okay. Now the last one that I have written, not the last one, but the next one that I have written amount is fixed amount installments.
Mm-hmm.
And the fixed amount installments is kind of similar
Mm-hmm.
to the one that's above it, the fixed period, but you're
Mm-hmm.
asking for a certain amount
Mm-hmm.
given to you every month. So I don't know. I mean, at the top of them, maybe you want $1,000 a month or something like that, right?
Mm-hmm.
Then that's what they'll pay you. Um, and if I'm not mistaken, that's until they'll pay you. I'm hungry. That amount will pay you until you pass away. That certain amount of time. That certain amount of money gets paid to you until you pass away.
Which one for the fixed
The
amount
fixed
installments?
fixed amount, yeah,
Yeah. So they'll continue paying you until the money runs out. So
until
fixed
the money
amount
runs out. So what happens if you pass away before the money runs out? Then it goes to
so
the beneficiary.
yeah, it goes to whoever you designate, or it goes to your estate.
Okay, so fixed amount
Mm-hmm.
is the certain amount that you choose, because you
Mm-hmm.
get to choose it, right? You get to choose a certain amount
Yeah.
that you want.
Mhm.
certain amount that I choose, and it's until the money of the benefit money runs out,
Mhm.
right? So
Yeah.
if it's $100,000, the
Mhm.
benefit is for $100,000. I can choose to get $10,000 a month until
Exactly.
those $100,000 are exhausted.
Exactly.
However, if I get, for example, it's $100,000 and I get $10,000, but I die the second month, so after getting $20,000,
Mhm.
the $80,000 as remaining will get paid to the beneficiaries
Perfect.
of your choosing, the ones that you have specified. And if there is no beneficiary or they cannot locate a beneficiary, that will get paid to your estate. The eighty
Perfect.
thousand dollar difference will get paid to your estate.
Perfect.
Perfect. Okay. Now let me just run through them one more time. Oh, wait. Nope. Last survivor or last survivor or serve how do I write it down? Yeah, let me say. Uh, last survivor or joint and survivor, right?
Mhm. Yeah.
Okay, so that one, if it's the last survivor, then say you have two beneficiaries that are getting this because it's two people that you choose.
Mhm.
So they both will get a certain amount, right?
Mhm.
However, if one of them dies first,
Mhm.
then the money ceases to come into it. They stop receiving payments.
Exactly.
Now, if it's joint and survivor, um, it's you get paid until the last person dies.
Perfect.
So between the two people,
Mhm.
so just to clarify, last survivor is when the first person dies, correct? That's last survivor, right?
No, no, no. Joint, joint is for both joint and survivor, last survivor. Again, another name for last survivor is called last to die, joint and survivor, or second to die, but it all mean the same. So for last survivor, uh,
That's when the last person,
to
that's when
die.
the second beneficiary dies.
Exactly, until the last survivor dies. So payments will continue until the last survivor dies.
And
Whereas
what's
for
it called
joint,
when it's the first with the first
when
person?
the
That
first person dies, it's just joint.
joint. Okay,
So
okay,
when you
I
think
wrote that
about
wrong.
survivor, just think about survivor, right? Someone surviving you, right? So they say this person is survived by. So for survivorship, only the only only the last no, the payments only cease when the last survivor dies.
So let me recap really quick. That way I kind of see anything. Okay, so lump sum.
Mhm.
When you get lump sum, that's not taxed. That is
Yes,
completely free from being taxed. The one that
exactly.
is taxed is interest only. That's when you get interest only payments to a certain beneficiary. You designate a beneficiary that gets only the interest. And if
Mhm.
that person passes away, then your other beneficiaries will get the lump sum.
Yes.
Okay. Now, life income option is when you get um, a certain amount of money um, until basically you pass away, right?
Mhm.
Okay. Fixed period payments are, for example, if you choose 10 years, right, then you'll get a certain amount of money for 10 years until it's exhausted, or if you pass away before those 10 years are up, your
Mhm.
beneficiaries will get the paid difference.
Mhm.
Okay. The fixed amount is just that, is you get a fixed amount a month until the, the benefit is exhausted.
Yeah.
Yeah. But again, also if you die before that whole thing's exhausted, then your beneficiaries will also get will get the difference, correct?
Perfect.
It's similar to the top one, but when it's fixed period,
Mhm.
you're choosing a certain amount of time that you're going to get the money for. But when it's fixed amount, you're choosing the amount of money that you get.
Mhm.
Okay. And then there's the last survivor. The last survivor is or last to die, right? So survivor is when Joint and survivor is when survivor is when you have two beneficiaries and both of them die, then payments cease to stop. But if
Perfect.
it's joint,
Mhm.
the benefits stop upon the
Perfect.
first beneficiary's death.
Perfect. Look at
Yes,
this. And trust me, that's for the life insurance. That's usually this session is the most difficult for a lot of people.
I can see why.
Yeah, yeah. This is the most difficult. All right. So we are making progress. We're here. The next item on our list here, as you can see, on your exam outline, the state of Washington. The next option here is non-forfeiture options. So what are non-forfeiture options? In your own words, tell me what non-forfeiture options are.
Say that one more time, please.
What does non-forfeiture options mean, or what's the purpose of non-forfeiture options?
Non-forfeiture options. Okay. Man, I know this one because we went through this a while ago. Non-forfeiture options are basically you're not giving up forfeiting, right? You're not giving up a certain payment. You're not giving up a certain amount. So let's say you have a certain amount of cash value in your benefit, right? But you want to surrender, but you don't want to give up a certain amount. Then you can choose that option to get that certain amount given to you, even though you surrender the policy. Is that kind of, did I kind of get that right?
Yeah, that's partially true.
Okay. Okay. So let me get my notes out and let me write it down. Okay. That's kind of what is it? Okay, here we go. Okay. So non-forfeiture option. Okay, go ahead.
So non-forfeiture options, just think about this, right? When, as you said, forfeiture means you're losing something, right?
Yeah.
So the non-forfeiture options were put in place for you to not lose all of your life insurance policy. Now, few things to know about non-forfeiture options. Number one, it is only for life insurance. Now, it's only for permanent life insurance. So let me switch my page over here.
So it's so that you don't lose
It's only,
all of your benefit. Is that what you said?
exactly. So you don't lose. It's put in place for you to not lose all your cash value, right?
Cash value. Okay.
Yeah. Or lose all the benefits of life insurance. So non-forfeiture options. It's right here. Non-forfeiture. And please excuse my writing. It's terrible. Yeah, people are like, oh my God, your writing is almost like it's like
Hey, no,
chicken
no.
scratching.
You have a pharmacist writer handwriting,
Yeah,
and pharmacists are just like doctors.
exactly.
They write, and sometimes when I saw their writing, I'm like, what is this? Interpret this for me.
Yeah. So you have non-forfeiture options. So now the non-forfeiture options are just meant for you to not lose all the benefits or all the value of your life insurance. So think about it, right? If you have a house, let's say you live in that house for 30 years, and for whatever reason, let's say you want to, you want to sell that house, right? You will expect that when you sell the house, you should be able to walk away with something, right?
Right.
Exactly. So if I don't want the house for whatever reason, number one, I can choose to just sell the house. Okay, I'd like to give you a life example. So let's say Cruz, Cruz has a $500,000 house, but like the kids have moved out of the house. Maybe it's a 500,000 5-bedroom house. You have a beautiful house by the lake, with ocean view and all of that stuff. With a deck.
One day.
Yeah, with a deck and all of that, swimming pool, and you have all of that, right?
Right.
and and the kids move out, because most time people downsize when the kids move out of the house, right? So you and your wife think like, oh, there's no need for us to have a 5-bedroom house and it's just the two of us in this house. So let's downsize. We can go and get a 2-bedroom condo or stuff like that, right? But you've owned this house for 30 years, right? And you've owned it for 30 years and you have, I don't know, let's say you have $100,000 equity. So the non-forfeiture option, if I were to use that example, we say, okay, you've owned this house for 30 years. It won't be fair for you to, if you want to get rid of it, for you to walk away with nothing. You have to walk away with something, right?
Right.
So the first non-forfeiture option is called cash surrender value, or just cash. They may just say cash or cash surrender value. So Cruz, you and your wife can decide, you know what? We're just going to sell this house and just walk away with our cash. We have $100,000 cash. We can just sell this and walk away with the cash, right? So cash surrender value is the first non-forfeiture option, right? So I have 100,000. Yeah, I have 100,000 in my equity. I have 100,000 equity. I'll sell it and walk away with my 100,000. Or in this case, in life insurance, your equity is your cash value, right? Because it's how much you can walk away with if you had to cancel your policy, right? So I say, okay, my cash. Now, the key thing is cash surrender value. Now, I don't want to get too much in the weeds here, but I got to explain the difference. So cash value is what you have. It's what you have. Okay, it's what it is your money, but you don't have access to all of it. So cash value is your money minus surrender charges. What are surrender charges? Surrender charges in annuities and life insurance are like early termination fees. So for example, if you have, I'm trying to give a real life example here. What's the real life? Okay, so okay, say you have a contract, right? And they tell you, Cruz, we're signing a 10-year contract with you. But if you decide to cancel this contract in the first year, we're going to charge you a 10% fee or 10% penalty, right? Okay. The longer you keep the contract, the lower that penalty gets. So by the like every year it goes down by it goes down by 1%. So if you cancel in the third year, now you're only paying 7% interest. If you 7% penalty. If you cancel in the fifth year, you're only paying 5% penalty, right? So the whole goal of the cash surrender period or the surrender charge is to discourage people from just getting life insurance to just cash out. Because in the beginning, that's what people used to do. A lot of rich people used to take advantage of it, right? They'll just dump a lot of money there. Within 2-3 years, boom, they take out everything. They say, no. We want you to keep this for at least 10 years, because almost all the life insurance policies will have a 10-year surrender charge. So if you cancel your policy within the first 10 years, you're going to have, they'll take out a certain percentage of your cash value as a penalty. So that kind of discourages people from canceling their life insurance policy, because the government doesn't want this to be like a way to get around taxes where you just dump money and take out money. So they say, okay, if you want it, you must really be getting it for life insurance and not for investment purposes. So you got to keep it for at least 10 years. So that is what surrender. And now surrender may be on your exam. I think it's on your.
It is actually, because that's one of the things that came up.
Yeah. Okay, perfect. Yeah, I see surrenders on your exam outline. So that is also, so think about surrender as your early termination penalty, right? The same way, if you have a 401k, if you take out your 401k before age 59 and a half, you get a 10% tax penalty, right? So if that were life insurance, that 10% penalty will be considered a surrender charge, because you're canceling or you're withdrawing, your money early, right?
So if the benefit is $100,000 and you cancel that, so say the early termination fee, the surrender fee is 10%. If I cancel it after the first year, so out of the $100,000, $10,000 is going to go for the company to say, hey, you surrendered, I get $10,000, you get $90,000.
Yeah, perfect.
Okay.
Yeah. So yeah, that's it. So pretty much that is your surrender. So now the other thing to know is your surrender charge decreases for every year that you keep the policy in force. This is why you want to tell your clients to keep your policy in force for at least 10 years, right? At least 10 years. No. So now, so your cash surrender value is the money you have. No, the money you have plus, no, the money you have plus the surrender. No, what the money you have access to without the surrender charge. No, I'm sorry. Okay, let me rephrase this. Cash surrender value is your cash value minus your surrender charge. So let me switch here to my document camera. So your cash, I'll just abbreviate it as CSV, right? Cash surrender value will be your cash value, which is your savings account, cash value minus surrender charge or surrender fee. So for example, let's say you have $100,000 in your cash value, but your surrender charge is, let's say it's 10%, right? Your surrender fee. So that's $10,000, right? So your cash surrender value now would be 100,000 minus 10,000 would be 90,000. So now that 100,000 is your money. No.
But because you canceled it before the time period, they take away the $10,000.
Exactly.
And so now you're left with 90.
Perfect. So your cash value is your money, assuming you don't take it out before 10 years, right?
Okay.
But the cash surrender value is the money that you have access to take now. So for the first 10 years in most life insurance policies, for the first 10 years, your cash surrender value will most of the time be less than your cash surrender value. And then after 10 years, your cash value will equal your cash surrender value because now there's no more penalty. So if I got 100,000.
So if you reach, so like you have her for 10 years, right? You say for example, you have her for 10 years, right? When you reach year 10, your cash value and if you decide to surrender it, you don't get equal amount.
Exactly.
Okay. Yeah.
Okay.
Yeah, that makes sense.
Okay.
And maybe you might cover this later. I haven't looked at the outline yet, but you can borrow against it, correct? You can borrow your so out of that $100,000.
Yeah, you can borrow.
If I need $10,000, I can borrow $10,000.
Exactly. Yeah, you can take a policy loan tax free, and policy loans are never taxed. So
when I borrow that, I get $10,000. I don't get $900,000 or $800,000.
No. Yeah,
I get the full $10,000 because it's not taxed.
Yes.
Okay.
All right. So now we cover.
Quick question with that.
Yeah, sure.
So again, you might cover it. I might be getting ahead of myself. But when you do borrow it, right? When you pay it back, do you pay it back with the premiums plus whatever they ask you to pay it back, or is it just the premiums that you pay back to repay those $10,000 back into your? I don't know if that makes sense.
I'm not sure I understand your question.
So you know how like you have $100,000 cash value, okay, and I borrow $10,000 from that 100K. How do I pay that back with the premiums, or do I pay that back the premiums plus a certain amount?
No. So you can structure however you want, right? So if you take $10,000 out, you can choose to, I'll write a check for 10,000 and pay it back, or I'm going to pay it back in increments. So maybe I'll pay back 1,000 every month for the next 10 years, right? But paying that will be different from your premium. So when you pay your premium, they're going to ask you whether you're doing it online or you're doing it over the phone. They'll ask you, what is this premium going to? Is it going towards your loan, or is it going towards your regular premium payment?
Oh, okay.
Okay, so we just cover policy loans now. So as I said, policy loans are never taxed, and all cash value policy come with a policy loan provision. That means you, as the policy owner, as long as you have enough money in your cash value, you're allowed to take out policy loans.
And
Okay,
how
you're allowed
quickly
to
do
take a
you
loan.
get the cash value up? Like
Well,
you, so today is my first month of having the life insurance, right?
mhm.
How quickly does that get to
uh,
your
well,
100,000?
well, it depends on how you fund it, right? Because your cash value is like a savings account. So if you got two people, let's say you and I, you are saving $50 every month, but I'm saving 5,000 every month. Which one of us will build it? Which one of
Oh
us will
God,
have a lot of money faster,
definitely for
right?
you. Yeah.
Someone who's saving 5,000, right? So it's the same way with your life insurance. So the more money you put in, then the quicker you'll be able to access money.
Okay, I got
Yeah.
you.
Okay. So for policy loan, all you got to know is number one, it only comes with the permanent life insurance policy, because you know the difference between permanent and term insurance, right?
A permanent and term insurance.
You know the difference? So term insurance doesn't have cash value. Term insurance doesn't come with cash value, right? That's one of the main differences. Whereas permanent insurance comes with cash value. So it's like a savings component. So every time you make a premium payment, a certain percentage of that premium payment, usually between 60 to 70%, goes towards your savings account. And then the other 30% goes towards the cost of insurance.
So term insurance has no cash value, only
Exactly.
permanent insurance has it.
Only permanent insurance has cash value.
So anytime you see the word term insurance, you'll know that there is no cash value in it.
Perfect.
No
Never.
borrowing.
Term insurance never has cash value.
It's only the benefit after the person passes away.
Exactly.
Okay. Term.
Now,
There's now universal and variable.
those are all types of permanent insurance.
Those are all types of permanent insurance. Okay.
Yeah.
Okay. Insurance. And that includes universal, that includes variable and adjustable.
Yeah. Okay. So policy loans are only policy loans and withdrawals. Again, because you can't withdraw something if you don't have a savings account, right? You have a savings account or checking account. That's the only time you withdraw. You can't go to a bank and you don't have any account with them, and you like, hey, I want to withdraw money. The next thing they're going to call the cops on you.
Yeah.
You know, so the same thing with permanent life insurance. You know, the reason you're able to withdraw is because it's permanent life insurance. You have a savings account attached to it. Whereas term insurance, you don't have a savings account attached to it, so you cannot withdraw from term insurance. Okay, so with policy loans and withdrawal, they only come with permanent life insurance, and you can only withdraw money that you have there, right? So if you don't have the withdrawal comes from your cash surrender value, right? And the policy loans comes from your cash value. Okay, withdrawal comes.
Say the withdrawal.
Yeah, withdrawal comes
from your cash surrender value. The withdrawal is when you cancel a policy, right?
Well, you don't necessarily have to withdraw to cancel a policy to withdraw. Let's say you have $10,000. Instead of taking a policy loan, you can just do a withdrawal. So you have two ways to take out your money. You can withdraw it, or you can do a
or withdraw it all together, like say.
No. You don't have to withdraw. You can do partial withdrawal. So let's say I got 10,000 cash value, and let's say times got hard. I lost my job. I can go and take 5,000 out. So I'm withdrawing. That's a partial withdrawal. I'm not withdrawing everything. So as long as you don't take out everything, the policy is still active.
So withdrawal will be different than the loan. Like the withdrawal, I'm saying, hey, I need this $10,000. No, out of $100,000, I need these $10,000. Please give them to me.
Exactly.
And then you can go in and say, hey, I want a loan. So that way, so with a withdrawal, out of the $100,000 that you had, you take out 10,000. When you pass away and your beneficiaries, or when at the end of whatever happens, right?
Mhm.
When that policy gets paid out, with a withdrawal, if you take out $10,000, you'll only get $90,000 now.
Uh, exactly. So whether it's policy loans or withdrawal, but
Yeah.
the way it works is if whatever you don't pay back gets deducted from the how do you call it? It gets deducted from the death benefit.
Oh, okay, yeah. So yeah, so right. If I had $100,000 and I withdraw $10,000 at the end, I'll only get $90,000 at the end.
Exactly.
And then with the loan, if I don't pay that back, again, it'll get deducted from the benefit. So instead of 100, you'll get 90 because the loan didn't get paid all the way. Or whatever you did pay, the difference will get taken away from the end.
Exactly.
Okay.
So
Yes.
yeah. So policy loans, one of the difference between withdrawals and policy loans is that policy loans are never taxed, whereas withdrawal can be taxed if you take out more money than you put in. So let's say I only put in 10,000, but now my cash surrender value is 20,000. Well, anything I'm withdrawing more than 10,000, which is called my cost basis. Your cost basis, again, BASIS, your cost basis is what you put in, right? So anything you withdraw above your cost basis, again, anytime you make profit, Uncle Sam wants a cut, right? So if you take out withdrawal, then anything above what you put in will be taxed. Whereas a policy loan, you can even take out more than you put in, it's never taxed. So as an agent, you always want to advise your clients to take out policy loans and not withdrawals. That's a little tax loopholes.
Okay.
All right. So so we cover loans, we already cover automatic.
Oh, I get it. You're never taxed on debt.
Exactly.
Yeah, that's why it's better to take out the loan than to take out the withdrawal.
Perfect.
Debt is never taxed.
Okay. So
I understand what Robert Kiyosaki said. Now you never tax
yep.
on debt. I might as well make money off somebody else's money.
Yep. You use other people's money to make money. Yeah. So the first non-forfeiture option
Yes.
is the first non-forfeiture option is cash surrender value. Again, I explained, you sell your house, you walk away with the cash, you don't care. Now, the other option is extended term, right? So now keep in mind that extended term is the default non-forfeiture option. So if you don't pick any non-forfeiture option, this is what the insurance company will automatically select for you. So let's say you have $1,000 in your cash value and you want to cancel your policy for whatever reason. If you don't select an option, this is the option the insurance will select. So extended term just means though they're going to use the money in your cash value to buy term insurance for whatever length of time or whatever amount that I can buy. So they may, if that 1,000 you only buy a 10-year, 1,000, 10-year, 50,000 term policy, they're going to use that about term policy. So in that way, you always have insurance coverage. You may not have permanent life insurance coverage, but at least you have some type of life insurance coverage. So that is the default option. Now let's go back. What is the default settlement option?
For the settlement?
Yeah,
it would
you shouldn't look at
sum.
your notes. You shouldn't look at your notes. I try to see if you remember it all.
Okay, I won't look at my notes.
I see you look at your notes.
Yeah,
What is
I will
the
look
default
at
settlement
the
option?
default for the settlement option will be lump sum.
Perfect, cash lump sum.
That would not be taxed.
Perfect.
The second option would be the interest only.
Mm-hmm.
And then the other two options would be fixed amount or fixed period.
Mm-hmm.
And then the last one is joint and survivor.
Okay, perfect. So now,
okay.
Yeah.
So those are the main one out of the settlement
mm-hmm.
is the lump sum. That's the big one that people go with,
Mhm.
or the default, I should say.
Yeah. Okay.
Yes.
Yeah. Mhm.
Okay.
Cash lump sum. So extended
Or
term is the second non-forfeiture option, and then the third and final non-forfeiture option is reduced pay up. So now let's say you and your wife, you got $100,000 cash. He's like, okay, you know what? We're going to just go and buy now. I don't know in what state you can find a condo for 100,000, but who knows? Maybe there are some states out there. I know definitely not on the East Coast. Okay, because shoot, in Washington D.C. where I live, I mean it's crazy with housing prices. One, a girl I know, she just bought a 2-bedroom, 2-bath condo for 450,000, and I'm like, what is
the
going on?
condo.
Yeah, 2-bedroom, 2-bath is like I think it's 1,400 square feet condo for 450,000. That is crazy, but it's in
You know
Washington
how much
D.C.
out here where I live, in the area that I live,
Yeah.
we looked at a house by the lake. It was a 400, excuse me, 4 bedroom, 4 bedroom home, 2 story, 2-car garage, and a decent plot of land.
Mhm.
It was for roughly $400,000.
Wow, you see? Yeah. So for a place like Washington, who knows? You can get a condo for 100,000. But I can tell you, yeah, on the East Coast, like
There's no way.
where I am in Washington D.C., Maryland, it's impossible to find a condo for 100,000. It's just
The East
impossible.
Coast is the bread and butter of America, man. That's where all the money's made out of. Man.
Yeah. So it's impossible. But
That's
anyway,
why it's
so
so expensive to live out there. It's super
yeah.
expensive.
So let's say you and your wife take out that 100,000 now. You say, okay, we're going to buy, instead of living this big 5-bedroom house, we're going to take this 100,000 and pay cash for a condo, right? So now that condo will be considered reduced pay up, right? It is still a house, but it is a reduced value of what you had before, and it's paid off because you just pay off the mortgage, right? So you don't have to worry about, anything anymore. So it's reduced paid up insurance. So you're using your cash value, you're using your cash surrender value to just now take that money you have to just buy insurance, but you just pay off that insurance, right? So you don't have to be paying any premiums now. When the other thing with that is it has to be for the same policy, right? So if it's a whole life policy, you can only get a reduced pay of whole life policy. If it's a universal policy, universal life policy, you can only get a reduced paid up universal life insurance policy. So it has to be for the same type of policy, right? So it's called reduced because the value will be less than what you had, and it's called paid up because you just pay up for everything up front. So now the mnemonic I like to use for the non-forfeiture options is REC. REC. Because when you lose what you put so much money into, that's not good, right? That's a wreck. And most of the time people do that when they're in financial wreck. So just remember REC, REC. So R stands for reduce paid up. Reduce paid up. E stands for extended term. And C stands for cash surrender value. Or on the exam, they may just say cash or cash surrender value is all the same, cash surrender value. So this term REC, that's the mnemonic.
So let me the reduce paid up.
Mm-hmm.
Look at my notes really quick. Hang on, let me see if I can explain that right there.
Okay.
Okay, so reduce paid up is when you surrender a policy, right?
Mm-hmm.
And the policy, say like you don't choose whatever option you want. So say you choose a reduced paid up option, right? What it will do is out of those $100,000, say you only get 90,000, right? Because of the cash surrender charge. then what that option does is it takes either all or part of that amount and it purchases a life insurance for that amount,
Mhm.
right? And then it's not going to be permanent, it's going to be term because it's not a for everything. You just purchase whatever that 90,000 or whatever amount you choose, I guess, right?
Mhm.
Um, so say you choose 90,000, the reduced paid up version will only pay for whatever that $90,000 will cover.
Exactly.
Okay, perfect.
Yep, that's it. So what are the three non-forfeiture options?
Okay, I won't look at my notes. The three non-forfeiture options is the default, which is the extended term. That's the default one.
Okay.
And the extended term basically means that you will I just had it in my mind. Hold on. I'm gonna have to look at my notes on that one. The extended term. All right, let me come back to it. Let me come back.
Remember REC, REC, just if you
Yeah,
remember
okay.
the
So
Mhm.
reduced paid up, extended term, and cash surrender value. Those are the
Perfect. And
three.
which one is the default non-forfeiture option?
Extended term.
Perfect. Perfect. All right. So now we finished that. So you see everything here on our list is 20. And this is the most difficult option. You see it, 17 questions on your exam will come from this. Okay. This session we're covering 17 questions, right? Which is the session that will have the most, which is the session that will have the most number of questions. Okay. So let's come here to the next thing here. We have dividend options. Now, some life
What
insurance
page is that in? The 17? What page is that on? What page is that on?
Which one?
That one right there that you're in.
The dividend options?
Yeah.
Let's see here. The pages are not numbered, but let's see. 1, 2, 3, 4, 5, 6, page 6. Under dividend options. Here.
Am I on the wrong one? General concepts, life insurance basics, types of life policies, life insurance provisions. Okay.
Yeah.
Does it say provisions, options, and riders?
Yeah. Yeah. So
Okay.
the next page.
Yours says 17.
Huh?
Yours says 17.
Oh, mine doesn't have any page number on it.
No. Yours says 17 questions.
Yeah, 17.
I don't know if they updated it, but this one says 20 items.
20?
Yeah.
Okay. Well, this is the most recent because I just printed this one out about 2 weeks ago.
Okay.
So,
I see what you're looking at the life and disability one. Oh,
yeah,
okay.
the life and disability.
Okay.
Well, is that one just for the life?
Yeah, this one's just for the life. Yeah.
All right.
Okay. Nope. Perfect. No, that's fine. I'll look at. I was looking at the wrong one. Okay. Perfect.
All right. So now we're going to do dividend options. Now, you have some insurance company that pay dividends. So dividends, all you got to know is anytime a company experiences, or maybe the company earns more revenue than they, than they budgeted for or they projected, then they're going to share some of that revenue with their shareholders. But in this case,
it's found a mutual.
perfect.
Yes.
Okay. Oh, someone's going to ace this exam, man. I can wait for next week. Man, you're going to get 90%.
Wow.
Yeah,
that's only found in mutuals.
Mutual
And
insurance.
they're the only ones that will pay you
Mhm.
dividends if they make. It is not always certain, but when they do, that's what they pay.
Okay, perfect. And let's do a quick checklist. Are dividends ever guaranteed? Yes or no?
No.
And if an agent guarantees dividend, what would the agent be guilty of?
That is misleading. Is it misleading?
Misrepresentation.
Misrepresentation, yes.
But if an insurer guarantees dividends, what would the insurer be guilty of? False advertising.
I drew a complete blank on that one.
Yes.
Yeah,
So
yeah.
if the
You can,
insurer
you can,
does it, it's false advertising. If the agent does it, it's misrepresentation.
yeah, because when it comes to mutuals, you cannot guarantee that they're going to get anything.
Exactly.
It's up to the stock market and how well they do and how much money they get. That's all that well, not really the stock, yeah, stock market. That's what it is. Um, it depends on how much money they make. If they do make any money, then they'll pay
Mhm.
dividends. But it's not a guarantee. Like they cannot say, I as an insurance agent cannot tell somebody that has a mutual, hey, you're always going to get 7%. You
Exactly.
know, you can't tell them you're always going to get 10% because sometimes it can be uh, 1%, 2%. You know,
Mhm.
so it depends on how much they make.
Yeah. And that's another thing too. You cannot tell your clients that buying insurance is like buying buying shares of a stock. You can never say that also.
Yeah.
As an agent, you can never tell your clients that. That's against the law. Okay. So dividend options are given to policyholders by mutual insurance companies. So now you have for the dividend options, you have 6 dividend options, but on your exam here, they're going to test you on only 5. But I'll still include the other one just so you know. So let me I wrote those down already. So to save time on writing, I don't want to rewrite the whole thing. So let me pull that up here. Um, Perfect. Dividend options. So the mnemonic for dividend options to help you remember, just use CARPO. CARPPO. CARPO.
Okay.
CARPPO. CARPO. Okay. So C stands for cash. So the dividend option cash. Hey, give me my money. Give me my money. I want my cash, right? So if you
Yes.
got dividend, let's say you're with Geico life insurance, and Geico pays you $500 every quarter, as your dividend. You can tell Geico, you know what, just send me a check for my 500. I don't want to hear anything else. So cash. The second option is accumulation and interest. So this one is similar to the interest settlement option for life insurance. Again, remember one of the settlement options for life insurance is interest income, right? So this one is similar to that. They're just paying you the interest, right? So let my dividends sit there, but when you pay me interest on the dividend. So instead of giving me the 500, I want you to invest that 500 and just pay me the dividends. The pay me the interest I earn on that 500, right? So every time there's a dividend, just let's say every 3 months I get 500. So every year I'm getting 2,000 dividend. Don't pay it to me. Just give me the interest that you earn on that. So that's interest, right? That's it. Then R stands
What
for
happens to
reduction.
the not the interest, but it stays at 500,000, right? You always stay at 500,000. You'll always have that in there.
Well, what do you mean?
So accumulation and interest, when you're asking them to just pay you the interest, you still have the 500,000, like they're
What do
making
you mean
money.
500,000? Not the death benefit. You're just accruing interest on the dividend.
Okay. Oh. Okay.
Yeah,
So whenever they make extra money, instead
exactly.
of paying it to you, you're asking them to keep it there to make interest. Is that
Perfect. It pay you the
okay?
interest. Yeah. Then you have reduction of premium. So the reduction of premium, just saying that, okay, you know what? Instead of paying me that 500, apply that 500 to my premium. So now against my premium, so now I don't have to pay, premium, or maybe my premium is 1,000. That $500 now just use it to apply towards my premium. Instead of paying 1,000, now I pay 500, right? So that's reduction of premium. Now, where people get this, and this gets confused with the non-forfeiture option, right? Now, you have 2 dividend options that have paid up. One is paid up addition. So this one here, you're just buying small additional life insurance that you pay for upfront. So let's say that $500,000 you get, and let's say you have a whole life policy. You can say, you know what? I'm just going to use this to just buy maybe a $1,000 whole life policy, right? And I just use a 500 to just pay for it one time, right? So that's
Right.
paid up because you paid up for everything, and then addition, you're buying additional life insurance of the same thing. Now, the other dividend option is paid up. This one you're still paying for everything, but now option, right? So paid up option is you're actually using that
Move your
money.
paper just a bit up.
Huh?
Can you move the
Oh,
paper
pull it
just a
up.
bit up?
Okay.
There you go. Yeah.
Um, so paid up option is you're actually just using your dividend now to just pay for your life insurance early, to just pay off early, right? So think about it, right? Say you have a mortgage, no, and let's just say you get a tax refund. Like, oh my God, I got $5,000 tax refund. What am I going to do with this 5,000? What am I going to do? Oh, perfect. I can take this 5,000 and I can use it to pay towards my my mortgage, help to bring my mortgage payment down, right? Help to pay my mortgage off early, right? Because that will help to knock my mortgage payment down, and then boom, I can pay off early. So you know what? I got this extra cash. Let me use it to pay against my mortgage. So that is paid up addition, right? You're using that to pay up, to pay for your life insurance early. Okay. Now, the third dividend option, the sixth dividend option is 1 year term. So now you're just using that dividend to buy the maximum term policy you can get for 1 year. So if that $500,000 policy can only get you maybe a $50,000 1 year term, then you buy that. Or maybe it can get you a $10,000 1 year term, you get that. Now, whereas with the non-forfeiture options, it's extended term. So you can use it to buy term insurance for whatever length of time. Let's say you got a $500,000 policy, right? For the non-forfeiture options, you'll use that cash value to buy term insurance for whatever length of time it will take to cover that 500,000. So maybe you have 5,000 your cash value, and that 5,000 you can only use that 5,000 to buy 5 years of term insurance, right? 500,000 term insurance, you use that. But the 1 year term, you're only getting term insurance for 1 year, right? So the dividend, you're only using it to get 1 year term. So now this gets confusing. The only shortcut is to memorize it, right? I mean, there's no, understand it, but also memorize it. So you use, because people confuse the dividend options and the non-forfeiture options, they get it confused all the time, right? And we're going to go through some of the questions. It gets tricky. So just know the mnemonic. For non-forfeiture options, you only have 3. And the mnemonic is REC. Whereas for dividend options, you have 6. The mnemonic is CARPO, CARPPO, right? And I'll stop here and see what questions you have.
Okay. Go back to the paid up addition and the paid up options. Kind of just a little bit slower, so I can kind of got that, because I kind of understand it, but I want to make sure that I don't confuse those two.
Okay, so good. So I'll use mortgage as an example, because everybody understands mortgage, right? So now, say let's get back here to the example of your tax refund, right? So you are not expecting it, because tax refunds are not guaranteed, right? So you're not expecting to get any refund, but now you get $5,000 tax refund, which is a lot of money, right? So now you have to have 5,000 refund. What are you going to do with that 5,000 refund? Okay, well, you can use that 5,000 refund to, you can use that 5,000 refund to, let me see, paid up addition. That is not a good, that is not a good example. I'm trying to come with an example that will, okay. Oh, good. All right, now let's increase that amount. So let's say you have a settlement. You get injured in an accident, and the insurance company gives you 200,000. The insurance company gives you 200,000 cash, and you have a $500,000 mortgage, right? So the first thing you could do, no, so let's say is you have a single family home. The first thing you could do is, okay, I'm going to just use this $200,000 to just pay up my to pay up my mortgage early, right? I got $200,000 cash. I'm going to use it to pay up, to pay. So maybe this pay up is what confusing. Just change that word to up to pay off, right?
Okay.
Everybody understands pay off. Maybe that will help. So I'm going to use that to just pay off my mortgage early, right? So that is the pay up extra. I'm using extra cash to help pay up my mortgage early, right? Or I'm using the extra cash to help to pay for my life insurance early. Now, the other option is you can use paid up addition. Okay, that 200,000, I'm going to use that 200,000 to just pay for a single family home, but maybe not big. Maybe instead of a 5-bedroom house, I'm going to get a 2-bedroom house, right? But I'm going to use that 200,000 to just pay cash, to pay cash for a 2-bedroom house that's completely paid off, right? So the pay off addition, you're paying off, you're buying a new house but paying it off early, a smaller house but paying it off early. And the pay off addition, you're applying that towards your, towards your mortgage to pay off early. That is, that is the difference. Does that, and that's why I said this part tends to be the most confusing for a lot of people.
I can see why.
Yeah.
So let me kind of okay. I might botch this, but let me try and kind of give you what I got. All right. So dividend options, obviously, cash. Hey, I want my money back. Give me my money now, right? That gives you the full amount, $500,000, as you wrote there, right? That you asking for that full amount. Okay, so that's what that dividends option is. You get the cash amount. Accumulation at interest, you're saying, okay, I earned $2,000 interest, right? What you're saying is basically, no way. You're saying you put your $500, right? $500,000 down in there, right? And you're saying that you earned interest, but you don't want to get paid the full amount. Just give me the interest. Just give me whatever interest I make, right? Leave the money in there, but just give me the interest. Is that my?
No. Use that interest to help to pay off my life insurance early.
Okay. For the accumulation of interest.
Oh no, I'm sorry. I didn't get it. No, the accumulation of interest. Okay, yeah, leave it there.
You're basically saying, hey, pay me
to help me pay. Yeah, to let my dividend earn interest and pay me that interest.
Yeah. So whatever dividends is being paid for. So say your dividends is $500,000. You're asking for cash. That's the C, cash. Give me the dividends. Just give it to me. When you're saying dividends accumulation at interest, what you're saying is, cool. Instead of giving me my dividends, put it away and let me get the interest off that dividends.
Exactly.
Right?
Exactly.
Okay. So that's those two. Now, the reduction of premium is what you're saying is, instead of getting that money, put it towards the premiums. So I myself, out of my own pocket, don't have to pay any more premiums. That is going to be taken care of. Out of the dividends, every time I get dividends or whatever, use it towards my premiums instead.
Exactly.
And okay, so those three I get. Now here's the tricky ones right here. Paid off additions is you're using the dividends that they give you, right? And instead of you pocketing that money in your pocket, you're saying, say you have, like you said, I'll use your example, the house. Say you owe a certain amount of your house. We'll use those dividends to pay off whatever the dividends will help towards house. So if your house is 500,000, you've paid out of your own pocket into that house 250,000. What you're saying is, and if I get $500,000 in dividends, what you're saying is apply $250,000 of that dividends to my house to pay off my house, and
Perfect.
that
I mean,
keeps
that's the pay up option, right?
yeah,
Okay,
and
perfect.
then that's the payoff. Yeah, that or what you wrote paid. I liked it. Paid off option, paid up.
Mhm.
What you were saying is instead of getting those 500,000, I
Mhm.
keep myself 250 and I use the other 250 to pay off my mortgage. That's all. That's
Perfect.
completely done. Right?
Perfect. Mhm.
Okay. Now, paid paid up option. Um, that one is, if I'm not mistaken, that one is uh so paid up the additions. Are you the additions is the one where you use to pay off the
No, no,
mortgage?
the addition is what you used to buy as additional house, but smaller house.
Oh, okay. So I'm getting those confused. So the paid up additions is I take up those 250. Say I want to pocket 250 and I want to use 250.
Mhm.
250, I'll use it towards buying a smaller house.
Mhm.
So maybe either I want to like rent it or I want to
Mhm.
live in it, right? But
Yeah.
I use that 250 to purchase another property that's 250 or less, right?
Mhm.
Um, and then that's what that money will be used for. The paid up option, that's to pay off the mortgage of a house that I already have, right?
Exactly.
Oh man, okay, okay, so yeah,
So they say
so,
paid up addition. So just think about
yeah,
your adding.
you're adding towards what you have already. So
Exactly.
paid up additions is I have a house, but I want to use the dividends that I earn to
About
pay for another property that I
yeah,
want.
on another smaller property, yeah,
Yeah,
of the same kind.
and then the paid up option, the option one is I can take the 500,000 and
Mhm.
use it to pay off my mortgage. That means I have one property, and the paid up option is I can pay off that mortgage, that one mortgage that I have. But
Mhm.
in the additions, I can get another property. In the option, I can pay off the one that I already
Perfect.
have.
Perfect.
Okay. Now the last one, 1 year term. That one is I can use my dividends to purchase 1 year's worth of insurance, 1 year worth, like just basically a term. It's not a permanent one, is
Mhm.
a term I can use. As you wrote there, I can use either 50,000 or $10,000 to purchase just 1 year term.
Mhm.
Is that did I
Yeah,
kind
so
of
so no, so you can use that. You can use your dividend to purchase whatever amount of term for 1 year that will cover. So you can use it to purchase a 1 year term. If that can only buy $10,000 1 year term, that's fine. If it can only buy $5,000, but you use it to buy the maximum amount of 1 year term you can get.
if my dividends say my dividends, I had a really great year that they gave me $500,000 in dividend, right?
Mm-hmm.
And if I choose a 1 year term, and if 1 year, uh, it costs $20,000 for 1 year,
Mm-hmm.
I just use those 500,000, pay $20,000 for that 1 year, and
Mm-hmm.
I keep the rest. Is that correct?
Exactly. Exactly.
Man, that's pretty cool.
Yep.
So okay, yeah. So I know it's gonna sound like super redundant, but let me go through them one more time, and that way I
Okay.
can, because I want to really get that in my mind. So if you don't mind, I'll go through
Yeah,
them
no,
one more
that's
time.
fine.
Okay. Now, dividend options. That's for mutuals. That's for mutuals, right?
Mm-hmm.
The company made a really good year, and for the
Mm-hmm.
purposes of this, say they gave you $500,000 in dividends. Okay.
Mm-hmm.
So the first thing that you can do is you can say, all right, cool. Hey, $500,000. That sounds like a great amount of money. Give it to me. Give me the
Mm-hmm.
cash.
Mm-hmm.
So they'll give you the cash. That's the first. That's one option. The second option in Carpo cash, as the second one is accumulation at interest. What you're
Mm-hmm.
saying is, cool. I have $500,000 in dividends.
Mm-hmm.
Keep it and let me earn money. Let me earn interest on those $500,000 we're in the stock, right?
Mm-hmm.
I'll earn interest of those dividends,
Mm-hmm.
right?
Yep.
So instead of getting paid the full 500,000, I'll just be getting paid the interest that while it's sitting in the stock, as long as it makes good money, right?
Mhm.
I'll get interest earned on those $500,000 that dividends that they paid me, correct?
Mhm.
Okay. The reduction of premium is when I take those $500,000 and I say, hey, pay off my premiums. Here's the money. I don't want to pay out of my own pocket. Just use these dividends to pay off the premiums.
Mhm.
Okay. Paid up additions, my favorite one. This one is when you have a house and you want to take a certain amount, say you want to take out of the $500,000 dividends that they give you, say you want to use $250,000 to go purchase another smaller property. That's what additions means. You
Yeah.
go and add to what you have. You
Yeah.
go and purchase another property that's either
Of the
250
same type.
of the
So
same
for
type,
example,
right?
if it's
Right.
a single family home, you can get a smaller single family
Right.
home.
But you'll
You
instead
cannot
of
be a
getting
single family
so,
home
so
and then you go and get a trailer. No. So
right,
for
right.
example, if
So,
it's a whole
so you
life
live,
policy, you can get a smaller whole life policy, but it has to be of
yeah,
the same type.
right, right. So if I'm not mistaken, you live in a 3 bedroom home,
Mm-hmm.
uh, can you get a 2 bedroom? Can you go and purchase a 2 bedroom house?
Exactly.
Okay, so okay, yeah, and that's just for the purposes of this example that we're using the homes.
Mm-hmm.
Okay, so paid up additions is for example, I live in a 3 bedroom home, but I want to go purchase a 2 bedroom home. I can go ahead and do that.
Exactly.
But you keep your main home, you're just
Exactly.
purchasing a whole nother
Perfect.
property. Yeah,
Perfect.
you're just purchasing a smaller property, a smaller house, but you're keeping the house that you live in. So basically you can use that to rent out if you want or whatever you want to use it for.
Yeah.
Now, paid up option is when you take those $500,000 dividends and you use it towards your main home and you want to pay off the mortgage off that home. So that
Perfect.
way, those $500,000 goes towards paying completely the house off. Hey, sorry, sorry, my kids came in. Hang on. They came in showing me new toys that they got. um,
Ah,
so paid up option is when you buy buy your property that you own right now. You take those $500,000 dividends and you apply it towards the mortgage that you have right now. You owe no more mortgage. You're completely free of that debt. That's what the paid up option is.
yes.
Okay, and now the 1 year term, that's when you have $500,000 dividends that they give you, and you say, hey, I want to purchase a 1 year term. If that
Mhm.
1 year term is $10,000 or $50,000, whatever that 1 year term gives you, they'll use that money towards that, and then you can pocket the rest.
Yes.
Look at that.
No. You can use that 1 year term. You can use that policy to buy the maximum. You can use the dividend to buy the maximum term you can get for 1 year.
Yeah, but in most cases, it wouldn't even be the whole 500,000, will it?
That's a good question. I think you can use part of it. It doesn't have to be all of it.
Yeah, and the reason why we're using 500,000 is because this is the example that we came up with. Like if the dividends were $500,000, that's you can use that
Mhm.
money to pay a 1 year term, and whatever X amount that 1 year term costs, they'll use those $500,000 dividends to pay off that 1 year term, whatever it means. It could be 10,000, 5,000, whatever, but it's gonna pay off for 1 year,
Okay.
right?
Yeah. Yep. So
Cool.
so that's it. So you just understood, yeah, you just understood the most difficult part of the exam for a lot of people.
Man, yeah, no,
So
that was a mouthful at first, to be truthful with you. That is a little bit of a mouthful. I can understand why why it's hard.
uh, so now the next option here is disability riders. Now, so let's talk about riders quickly. What is rider?
Those are so you have your life benefit, right?
Mhm.
These are riders are additions that you can purchase on top of your benefits.
Okay,
That's the best
perfect.
way I understood it.
Yeah. So riders are just anything that you get extra in addition to what the standard policy comes with. So
Right.
for example, I give the example when I got out of school, young 20-something-year-old making six figures. I'm like, you know what? I deserve to get myself a BMW. So I got myself a BMW convertible, convertible, coupe convertible, so two-door. So, but I went and the base model, it didn't come with anything extra. But I said, you know what? I want to add some extra features. Number one, I want to have you know, I want to have heated leather seats, right? I want to have, because here's the thing, I'm African, and most Africans, including me, are very allergic to cold.
Right.
So I'm like, winter time, I want to be, I want to feel the heat.
Yeah.
So yes, so I got heated leather seats. The other thing I got, because I always get lost all the time, so I got like an onboard navigation system. So back then, it's not like now where most of the new cars have onboard navigation system,
You
like
have to
I'm
purchase your own
standard. Yeah,
GPS.
yeah,
Yeah.
but back then, if you wanted, most cars, you had to get your GPS. And that time, it's not like right now where almost all the smartphones come with GPS, right? Back then, you had to get a Garmin or you had to get a something. What was the other?
Tom Tom. It was one
Yeah,
of those Tom
yeah,
Toms that you
Tom
had to.
Tom. Yeah, and let's take down your. So I'm like,
Yeah.
nope, I don't want that because sometimes it will freeze and all of that. I said, nope, I want a navigation system added there. And I said, oh, I want OnStar, no OnStar service. So God forbid, just in case I'm in an accident or collision, they can call 911, locate me, and blah blah blah. So those are the three services I got. Extra, but those were extra services I got, extra features I got that didn't come standard, right? So for those I had to pay. I had to pay extra, so I ended up paying a few $1,000s more than I should have. So that's just what rider is. Another good example of rider is when you're in the drive-through lane at the checkout, and you go into McDonald's, right? So you get to the McDonald's checkout lane. It's been a long time since I ate McDonald's, by the way. So, and by the way, there's nothing, if you like McDonald's, that's more power to you. But you but you go to the drive-through lane, and what is standard McDonald's come with? It comes with a drink, comes with fries, and comes with your burger, right? So a drink, fries, and your burger. Now you may be like, oh, can I have, can I have ice cream? No, can I have ice cream with that? Oh, can I have maybe a side of I don't know what the options now McDonald's. I've not eaten there, but I heard McDonald's is McDonald's doing fruit now? Fruit where they sell like fruits in a cup.
Yeah, the little fruit cup, like
Yeah, the
parfait or
fruit cup.
whatever it's called.
Yeah. So it may be
Yeah.
like, oh, what? Give me a little fruit cup, and I want maybe ice cream and stuff. So you can add extra things to your order, right? But the standard McDonald's order is fries, drinks, and your burger. Anything
Yeah.
extra, you got to pay extra. Anything you want in addition to that, you got to pay extra, right? So for life insurance purposes, if we were to apply that to life insurance, the ice cream and that fruit, that fruit cup will be your riders, right? So your rider will just be anything extra, or maybe guys can relate to cars, but most guys relate to cars. So the car, for me, the example of that rider would be, the heated leather seats, the OnStar and the built-in navigation system, right? So rider is just anything that you add to what what your policy comes with. So you add anything extra. So first thing to know about rider is anytime you add a rider, it always increases the cost, right? So on the exam, you may ask, for example, no, John, John and Mary both have, no, John and Mary both have, no, a 10-year level term insurance, but John, has, no, but John has a, how do you go? Yeah, so John has a convertible and renewable 10-year term insurance. Mary has just a convertible 10-year level term insurance, right? Or they may even be more specific. John and Mary both have a 10-year, 50,000 level term insurance, but John um, uh, has a convertible and renewable feature added. Mary only has a convertible feature added. Which one is going to pay more? Which one who's going to pay more in premiums? A, John, Mary. C, no, A, John. C, Mary. No, B, no, none of the above, or both John and Mary. So you just got to know that anytime you add, the more riders you add to a policy, the
More
more
you pay.
expensive it is. So if for example, if you have a term insurance and you add it, you added converted rider to it, that means you can convert it to permanent policy anytime. That will be more expensive. If you add the renewability rider, that means it renews automatically every time. That is also expensive, right? The same thing with permanent policy. So if you add like your waiver of premium, let's just go over some quick riders. You have a lot of riders. You have year on your exam, you have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Yeah, you have 12 riders, right?
Oh,
So yeah, it's a lot of riders. So, but to make it easy, they separated them into 3 categories. So the first category is a disability rider. So that rider protects you against loss of income from disability. So the first disability rider is waiver of premium. So what that rider will do is, if you have a life insurance policy and you get disabled, right, then it will waive that premium payment, right, for as long as the disability lasts. So if the disability lasts for 10 years, then you don't have to pay any premium for 10 years, and your life insurance policy will still be active. So that's called waiver of premium rider. Then the next disability rider is disability income benefit. So that one is saying, okay, if I have a disability, I want you to pay me a certain amount of income every month, right? So that's the disability income benefit rider. Now
that's supplemental to your so what your social security would be,
perfect.
to and your unemployment if you get it, or your disability, whatever, right? This is
Exactly.
in addition to those items.
Perfect. Yeah.
Okay.
Then the last disability rider is the payer benefit rider. So anytime you think about payer benefit, think about juvenile policies. So juvenile policies are policies for, again, on the exam, they won't say minor policy, but just know minor and juvenile all mean the same, right? You're under the age of 18, right? So the juvenile policy is, so most of the time, like kids get life insurance, parents get life insurance for their kids, but they are the payer, right? But the kid cannot work, right? So now you get a payer benefit rider. So the payer benefit rider just says that, God forbid, if you, the payer, right, in this case, now the 10 times you're the parent, if you get disabled, now they're going to waive the premium payment. So the only difference between the payer benefit rider and the waiver of premium rider is both of them waive premium, but the payer benefit rider just waive premium payment for juvenile policies only, whereas the waiver of premium waives premium for all other policies, right? But when you think payer benefit rider, think about, it says a payer, right? Who is it benefiting? The payer is for juvenile policies, because if you got a policy for 17 years old, can work sometimes, but let's say you get a policy for a 13-year-old, I mean, they cannot work, so you got to pay that bill. So if something happens to you, this rider will continue to pay that premium up until a certain age, I think up until age 21. And then, it's assumed,
it converts.
yeah, it's assumed by that time the kid is out of college and everything, right? So they'll pay for up to a certain number of years. That's it. So for these riders, it may seem a lot, but all you got to do For these riders, you just got to understand two things about them. What is the purpose of the rider, or what's the definition of the rider, and and what is the use of the rider? That's it. Those are the two things you have to know for the rider. Or to just summarize it, what does the rider do, or what is the advantage of the rider? That's it. So we know for payer benefit, for premium waiver or premium, the waive premium in case of disability. For disability income rider, they give you an income when you're disabled. And for payer benefit rider, they also waive the waive the premium if the parent or the payer gets disabled on a juvenile policy. That's it. Those are the three things. Those are what you have to know. This one seems harder, but it's not as hard as let's say the policy options or the policy provisions. Okay, so that's rider. So we know that these three riders are for disability. So they may ask you, all of the following are disability riders except A, waiver of premium, B, disability income benefit, C, payer benefit, and D, family term rider. Or to make it very tricky, they may say accidental death. D, accidental death. And you see accidental death, but yeah, accident is disability, right? Because accident and disability,
yeah,
and you may end up getting it wrong, right? But disability, accidental death is not a disability rider. It's a type of death benefit rider, not a disability rider. So you got to know the three disability riders are waiver of premium, disability income, and payer benefits. And now we can go ahead and check that off on our checklist. Yeah, I can see you scoring at least a 90 on your exam. All right. Now, any questions on that?
No, they're self-explanatory. Like you said, look at the rider. What is the benefit of having that rider? And then from there, you can kind of see, oh, okay, this rider goes with this goes with that. So if a question shows up on your exam about a certain rider, you'll know in your head, oh, this goes with disability, or this goes with accidental death, whatever, so you just got to look at what they're talking about in regard to a rider, so you know which answer to choose. That's pretty
exactly. Good. So now the other types of riders are riders, they call that additional insured riders, right? So these riders add additional people to your life insurance. And your three. The spouse is pretty self-explanatory. So you're just adding your spouse to your life insurance. You're buying additional life insurance for your spouse by adding it to your policy and paying the premium for it. So let's say you have a $500,000 policy. You may say, I'll get a $100,000 spouse rider. So now I'm getting a $100,000 policy for my wife, but attaching it to mine. So it's a rider to your. And then you could do the same thing for your children. Maybe you and your wife don't get along, or two of you are, separated or whatever. You'd be like, what? I don't care about you anymore. I don't give a damn about you. I just care about my kids. So I'm gonna add my kids to my policy, right? But most of the time, for my people, is the family term rider. So as an agent, if you see the policy owner insisting that only the children be added to the policy, that means 9 out of 10 times there's trouble in paradise. No.
Don't know without even asking. As the
Exactly.
agent, oh, you want that? Oh, okay. Ooh, yeah. Trouble at home, are we?
Yeah, so you have the children rider, and then the third one, you have the family term rider. So the family term rider just combine the children and spouse. Okay, so children and spouse separate, family term rider. Now you're adding your children and spouse to your policy. That's it.
That's actually one of the questions that stuck me, because family. There was a question, I don't remember how they worded it, but the two options were family term and payer benefit. Okay. And I think the questions was something along the lines of, if you were if how do they word it? Here, let me see. I got a picture of it. So give me a second here. Let me
Mhm.
look at that because it had that option on there. Uh, for travel long internet. Okay. Oh, okay. Okay. Never mind. I thought I had it. Anyway, um, yeah, that was one of the that was a tricky one because sometimes they whenever they talk about children in the question and in regards to riders,
Mhm.
they'll always, as far as I know, the way that they every quiz that I've taken, they've always added payer benefit and family term rider as
Mhm.
one of the options to trick you, because
Exactly.
obviously you think children, and if the question's regarding to children, you
Mhm.
think family, right? That's the automatic one that you go to. So you have to
Mhm.
kind of really watch out and know the difference between the payer benefit rider and the
Mhm.
family term rider because
Exactly.
they do different things and they have different things.
Exactly. So yeah, so the riders are definitely easier than the um, than the policy options. Yeah, it's definitely easier. Um, so let's come here to the next one. Let's see here. Let's see. So the next one here is the riders affecting death benefits. Again, you got to know what these riders do, but you also got to know what category they fall under, right? So spouse, children, and family term rider fall under additional insured riders. Waiver of premium disability benefit and payer benefit fall under disability riders. So the next type of riders we have are riders affecting death benefit, right? So now you have 6 riders that affect the death benefit. Number one is the accidental death benefit. Now you may see it go by accidental death and dismemberment. So this one, like the A, D, and D, is not just for death, but kind of dismemberment, right? So if you become dismembered, that's to say you lose a limb or whatever, arms, all of that. But this one is just accidental death. So usually the accidental death benefit will pay you, at least 2 times, between 2 to 3 times the death benefit. So let's say Cruz has an accidental death benefit to his policy. So he say, okay, let's say you have a $500,000 death benefit, you add a you know how you call it? Yeah, you add an accidental death benefit. Another name for it, uh, um, another name is the double indemnity rider. So PAU, now the accidental death benefit rider comes in two. You have triple indemnity and double indemnity. So double will just pay 2 times the death benefit. Triple would pay 3 times the death benefit. But that rider pays, let's say in this case, let's say accidental death, let's just assume it's double. It will pay double the death benefit, right? If you die as a result of an accident within 90 days. So let's say, God forbid, you're involved in in a car accident and you died 1 week after the car accident, right? And you have a $500,000 policy that has the accidental death rider. Instead of them paying your family 500, they'll pay your family 1 million. Now, this is besides the exam. I like to throw in some real world, teaching experience here. You probably don't want to tell if you're suspicious of anybody you have as a beneficiary. You probably don't want to let them know you have the accidental death rider. You know why? Because life is unpredictable, right? So let's say you have a
They might
triple.
want to use it.
Yeah. So let's say you have a triple accidental death benefit rider, and now you're God forbid, you're in an accident. Let's say you have a $1 million policy, but you have a triple accidental death death benefit rider, and you're on life support, and your family is like, damn, if we pull the plug now, we get 3 mil. if we pull the plug on dad right now, we get 3 mil. But if we let him, if we keep him there past 90 days, we only get 1 mil. So let's just pull the plug now.
Oh, no, let's wait a little bit and then we can do it.
Yeah. So you always want to be careful. I mean, because let's face it, right? It's sad, but it's the truth. You have some people out there, even some of your own family members, that will not mind pulling a plug if they can get more money.
Yes. That's so true.
So yeah, so you just have to be careful who you tell about that. Yeah, if you tell the wrong person, you may end up cutting your life short.
So true. Yes.
All right. So the next rider is the so the accidental death benefit rider increases, it increases the death benefit, right? So it increases death benefit. So these riders
so with the increase in death benefit amount, right? Because you obviously have to pay a higher premium then, right? Because you're
of course.
Yeah. So with because not only you're increasing, but the simple fact that it's a rider on top of your premium, a rider will always increase your premium because this is an addition to what you're getting.
Perfect. Yeah. So the next rider is the guarantee insurability rider. So now for guarantee insurability rider, number one, you got to know that this will guarantee, you additional coverage, and the key word is at specified times in the future, right? So they may say, or the key things is, and I don't know if you know this, but if you don't know, you want to take notes. So it will guarantee future increase in death benefits at specified times. The key word is specified, because they want to specify, or maybe 3 years, maybe every 3 years or every 5 years, like that, right? You can increase, so they'll specify. But the other key for the guarantee insurability rider is that you can get additional insurance in the future without having to prove insurability, right? Because we all know life happens. The older you become, the more health problems that will come up. So if you get a policy now and you don't have the guarantee insurability rider, and let's say 10 years later you want to increase your coverage, and now God forbid you have cancer, well, they can't increase your coverage. But if you have the guarantee insurability rider, it's just guaranteeing you that you'll be insurable, right? So it doesn't matter what your health status is. They're guaranteeing you that at a certain time in the future you can add X number of death benefit to your policy. So maybe 50,000 or whatever. So the two things to know about the guarantee insurability rider is, number one, it guarantees you additional death benefits at specified times in the future, and two, without having to show evidence of insurability. So that's by your health. So we know guarantee insurability will increase the death benefit, right? So you got to know which one of these riders increases and decreases death benefit. Now, the other one is the cost of living rider A. I'm sure all of you can attest to this. I don't know if you're living in America and gas price has not gone up for you, then please tell me what part of America you are living, because I want to come and live there. I was just driving. Actually yesterday evening, and I saw gas $5.93 for premium. $5.93. I mean,
here is $5.99 already.
Yeah. I've been in America 20 years, right? And I've never. I mean, I never remember gas being that high. Never in my life. So
you remember when the price jumped from $1.99 to $2? Everybody was like,
yeah. Because it usually cost me, before this price hack, it usually used to cost me like $45 to fill up my tank, right? Between 45, no more than $50. Because my tank takes 16 gallons of gas. But I went to fill up my tank, I think it was last week. And you know how you just put the handle down, and then you go back in your car, you press it like
Yeah.
automatic pump.
Yeah.
So no, I didn't really pay attention to the price. And I just went and said, so when it's when my tank is filled and I go,
Stop.
yeah, and it stops, and I look at the stuff, and because for some of you, well, for you guys on the podcast, you don't see, but no, I wear glasses, right? So I'm like, hold up, there must be something wrong with my glasses. I saw $87. I'm like, what? $87 to fill up a tank? So I pulled off my glasses and I went close. I went close to the price to just make sure my eyes were not playing trick on me. And sure enough, it was $87. I was like, what? I've never paid more than $50 to fill up my tank, and now it's $85 to fill up my tank.
Oh, no.
So right there, that is inflation, right? Inflation just means prices going up, right? So we always 99.9% of the time prices will always go up, right? But with the cost of living rider, is just saying that your death benefit will go up based on the inflation, right? So if
Right now, it's almost about 7 or 8%.
yeah,
So
it's
if I had
8%.
it right now, the cost of living rider will give me
8%.
8%.
Perfect. So now your death benefit will be increased based on the based on the percentage. No, they'll usually use a consumer price index. No, they'll usually use the consumer price index, right? The CPI. So if the CPI goes up 2%, then your death benefit will increase 2%, and they adjust that every year, right? So again, this is something that you can get for your clients to where, because $500,000 now will not be the same as $500,000 20 years from now, right? It's going to be worth a whole lot less. So you can do the cost of insurance, the cost of living rider.
Somebody posted on Facebook and said, "Hey, guys want to know the new dollar bill?" They showed a $20 bill. The $20 bill has now become the new $1 bill.
Yeah, it's crazy. Price of gas. I don't anyway. Yeah. So now the other rider is called return of premium. So you're going to find this on term insurance policy. So the return of premium, just saying that if you don't die within these 10 years, right? If your term policy, if you outlive your term policy, right, then the insurance company will pay you the death benefit in addition to all the premiums you pay. So let's say you have
basically you got it for free. That's kind of what it's
perfect. So let's say you got a $100,000 term policy, and over the course of 10 years, you pay $10,000 in premium. So the insurance will pay you $100,000. Your benefit, they'll pay you $100,000 plus 10,000, so $110,000. So that they'll just return the premium to you. If you die, if you outlive the term, right? So if you outlive the term, the return of premium. If you outlive the term, then it's going to return the premiums to you. Yeah. They're going to return the premium to you. Now, the other rider you have is called the accelerated benefit rider, right?
Or accelerated death benefit. When you have a illness,
terminal illness. Yeah, sometimes all the time, but sometimes if you have chronic illness, depending on the policy.
Yeah, it's like it has to be like a chronic illness, like cancer or something major, some major illness, and either you need massive surgery or you need massive treatment. And what it does is it will give you the ability to access your benefits before you pass away. So you're able to tap into those 100,000, 400,000, whatever amount benefit is. It will actually give you the ability to access that because you're in need of your because of your condition.
Exactly. Perfect. And that's considered a living benefit. So they may ask you, all of the following are examples of living benefits of life insurance, except, or they may ask you which of the following, or they may ask you all of the following are examples of living benefits of life insurance, except A, long-term care insurance, B, accelerated death benefit rider, C, C, return of premium, D, guarantee insurability. Well, we know return of premium is a living benefit. Well, you get it while you're alive, right? So if you don't die during your term, then you get all your premiums returned to you. Accelerated death benefit, when you're alive, you get, if you're diagnosed with terminal illness, you get some of that money back, or portion. You can get actually up to 100%, right? So on the exam, they may say up to 90% of death benefit, up to 100. So if you have a terminal illness, you can get up to 100% of your death benefit. This is what makes life insurance a powerful tool, because now for like literally $15 or $20 a month, you can be guaranteeing yourself to have something, if God forbid you have a terminal illness where you get, even 500,000, so while you're still alive. So then the last one is long-term care rider, right? So the long-term care rider will just add long-term care insurance to your policy. So if you have any long-term medical issue, then they're going to pay for the cost of long-term care. So these are the 6 riders. These are the riders that affect your death benefit. So you got the accidental death, guarantee insurability, cost of living, return of premium, accelerated benefit rider, and long-term care. So with that, I know the kids are hungry. I just got your text. So we're going to stop here, and we are going to resume later on. So we'll stop here.